On the surface level, right? The hypothetical options trader, they come in, you're a beginner, you're thinking in the money, that's a good thing.
Yeah, that's what I would think.
Right? Could you kind of explain the circumstances where maybe that's not always a good thing?
It depends, right?
Yeah. Hey, I'm Desiree.
And I'm Denver.
Welcome to Options Trading Essentials, a video series dedicated to teaching you the ins and outs of options trading. In this episode, we're diving into call options. Remember from our last episode, there are two types of options, calls and puts.
Each is equally important, and understanding how they work is a key building block as we begin to think about how to trade them.
And so in this episode, we'll explain in detail what a call option is, as well as the rights of buyers and obligations of sellers.
And later on, Kendall and Obi will introduce the concept of in the money, at the money, and out of the money call options. But first, let's start simple. What is a call option?
As we discussed in our last episode, a call option is a contract that gives its owner the right to buy 100 shares of the underlying stock at the strike price on or before the expiration date. You might think of a call option like a grocery store coupon. It specifies what you can buy and how much of it, and it has an expiration date. After the coupon expires, you can no longer use it. However, unlike clipping a coupon, an options buyer must pay a price, or what we call a premium, to purchase the option. The value of the premium fluctuates based on a number of factors, which we'll discuss in future episodes. For every buyer of a call option, there is a seller. The seller not only receives the option premium paid by the buyer, but also agrees to take the opposite side of the trade. In other words, the seller is taking on the obligation of potentially selling 100 shares of the underlying stock at the strike price on or before expiration. One last thing. Buyers of call options are typically bullish. They want the underlying stock to go up. Meanwhile, sellers of call options are typically bearish. They're hoping the price of the underlying stock goes down. Obi, walk us through an example.
All right, let's take a look at an example call option. Here I have the XYZ October 22nd, 2021 $75 call option. And this option is currently trading for a price of $3, the options premium. Now, what happens when we buy or sell a call option? Well, let's start with the buyer. They are paying our seller that $3 premium. Now, remember, each options contract controls 100 shares, so we have to multiply that premium by 100. So really, we are paying $300, which is 3, the premium, times 100, the shares per contract, to the seller. Now, the seller is keeping that $300 in premium, and in exchange, they are obligated to sell us shares of XYZ at $75 on or before October 22nd of 2021. And so by collecting that premium, they are exchanging to the buyer the right to buy XYZ at $75 by 10/22/21. What happens next? Well, this is an important thing, and we're going to introduce a concept here in options trading, which we call moneyness. Now, what does that mean? Well, we're going to introduce the terms in the money and out of the money. Let's explain what those mean. So looking at this example, we have an example stock chart here. And let's just imagine XYZ is kind of moving along, going up and down, up and down. And the stock is currently trading for $70 when this transaction takes place. And we're just going to say that that is today or now. Meanwhile, this option has an expiration date out in the future of 10/22/21. So I'm just going to label that on our chart as expiration. And so the buyer of this option is hoping that the stock rises above this $75 strike price before expiration. Now, why is that the case? Well, if you have the right to buy stock at $75, you hope that at the time you choose to exercise that right, the stock is trading well above that. Think about it. If I have the right to buy stock at $75 and it's trading, say, at $60, why would I exercise that option? I would just go out and buy the shares in the open market. But if the stock was trading, say, at $100 and I have the right to buy it at $75, I essentially can buy the stock at a $25 discount to the current market price. So what does that have to do with the option and this concept of in the money and out of the money? Well, let's imagine the stock rises in scenario 1 and it goes all the way to $80 before expiration. We would say that this option is in the money, and I'm just going to notate that with ITM. This means that if we were to exercise our option to buy the stock at 75, there would be some built-in value to the shares that we take over. In this case, it would be $5, right? We are buying the shares at 75, they're currently trading at 80. We would have a potential value in that option of $5 per share. So in this scenario, with the stock moving to $80 by expiration, and if we chose to exercise our right to buy shares at 75, we would have a built-in profit of $2 per share because we're taking into account the fact that we paid $3 for that option. So this is what we call when an option is in the money. Now, what happens if the stock goes down, right? So as the stock goes down before expiration, there would be no reason for us to exercise this right to purchase shares at 75. I mean, let's imagine the stock just dropped to 50. Why would we buy shares at 75 where we can just go into the open market and pay $50 a share for them? This is what we call an option that is out of the money, or OTM. This means there's no reason for us to exercise this option to purchase the stock at 75. And if we reach expiration and an option is out of the money, that option would be worthless. So these are the two scenarios. If the stock goes above our strike price, that option would be in the money. And if the stock goes below our strike price, that option would be out of the money. So when we buy a call option, we want that stock to go up, and we want it to go up above our strike price before we reach expiration. And if it doesn't, that $3 premium we pay for the option, well, at expiration on October 22nd, that price tag is going to be $0.
Believe it or not, when the CBOE opened its doors in 1973, the first day of floor trading was limited to call options on only 16 stocks. Compared to today's option market, the first day's volume was minuscule, with only 911 contracts traded. The first group of underlyings included companies like AT&T, Eastman Kodak, Ford, McDonald's, Texas Instruments, and more. According to the New York Times, the first call option traded on the new exchange was the July 160 call on Xerox. Soon after, 16 more stocks had listed options, including well-known names like IBM, Exxon, and Sears. Now, options trading is available on nearly every listed stock and on a number of other financial products like ETFs and futures. We covered a lot of important topics. In the money, out of the money, and at the money. Denver, can you show us this in an options chain?
Yep, absolutely. All right. So we hop into our app. We land on our investing page. We go search. Let's do McDonald's. So C, D, there we are. You select it. Trade options. We see our expiration dates. We are now on calls. We zoom in to the share price. It's at $239.47. We see prices above it. We see prices below. I need some context, guys.
So you can see that share price for McDonald's in this case is kind of split your screen, and it separated the strikes of these contracts on the options chain. So that separation is pretty crucial. Now we're looking at call options here, so you have to remember call up, right? When you own a call option, you want the underlying stock to go up in value, ultimately above your strike price. So in this case, for McDonald's, for example, you have the share price in the middle of the screen, and everything below that share price, all of those contracts are in the money.
Now, let's say McDonald's is trading exactly at the strike price of your contract. You're then at the money. And if McDonald's is trading below the strike price of your contract, you are out of the money.
For example, once again, the stock's trading at 239.63 right now. That 230 call is in the money. That 225 call is in the money. Meanwhile, everything above that line, the 240, the 245, the 250, those are out of the money options. And Kendall referenced sort of the at the money option. So as traders, when we talk about the at the money strike, it's going to be the strike that's closest to the current stock price. So looking at this option chain right now, as a trader, we would say that 240 call was the at the money strike. Even though it's technically out of the money, we refer to that as the at the money strike, just speaking as traders. At the end of the day, if we owned the in the money options, pick one, right? Let's say we own that 220 call and we decided to exercise our right, in this case, to buy 100 shares at $220. With the stock trading at 239, is that good or bad for us? Like, what would you rather do? Buy the stock at 220 or 239?
220.
Why? It's cheaper, right?
Yeah.
So when an option is in the money, there's some benefit or value for that options holder to exercise their rights. Now, of course, this isn't necessarily how you trade an option, but if someone wanted to exercise that contract, there would be an economical reason to. Now let's flip it to the out of the money options. If we own the 250 call, which is currently out of the money, Denver, would you rather buy McDonald's at $239.70, its current price, or would you exercise your right to buy it at $250 if you own that call?
The $239.70.
Why?
Well, it's a lower price.
It's cheaper.
It's cheaper.
So you can see just by asking these very simple questions, the phrase in the money, out of the money starts to make a little more sense, right? If you have an option that's in the money and you were to exercise it, there's some built-in value to the underlying stock position that you would take ownership of. Meanwhile, an out of the money option, there's no reason for us to exercise that really, because at the end of the day, we could buy the shares cheaper in the open market.
So on the surface level, right? Options, hypothetical options trader, they come in, you're a beginner, you're thinking in the money, that's a good thing.
Yeah, that's what I would think.
Right? Could you kind of explain the circumstances where maybe that's not always a good thing?
It depends, right?
Yeah.
If, for example, you're the buyer of an option, in this case, a call option, we want the option to become in the money because that's going to increase the value of the option. And remember, when we talk about trading options, eventually we want to talk about buying an option at a price and hopefully selling it for a higher price before expiration.
I just want to add on the flip side, we're talking about call options here. If you're the seller of a call option, so you've sold a call option, you don't really want the call to go in the money because you could then potentially be assigned. Or if you want to close the position in the market and you want to get out, that premium is going to be higher that you need to pay to close your position. So that would be a perfect example of when you don't want the contract to be in the money. So it really depends on what side of the trade you're on, what your stance is, and what the strategy is that you're going for.
I see. This is where both sides come into play, and then it's really important to know that there are buyers and sellers, and depending on which side you're on, will change.
Yep. And the last thing I want to point out, you can buy an option that's in the money. If we wanted to open a position, we could buy the 235 call. We would be buying an in the money option. We would be paying more for it. You can see right there, it's about a $7.30 option.
Yeah.
Relative to say the 250 call, which is an out of the money option that's trading for $1.08, you can see that in the money options are more valuable. And so if you're going to trade one and open a position, you're gonna have to cough up more money.
Is it more valuable because there's a better chance of it actually being in the money?
Absolutely. Like at the end of the day, an option's value is very much tied to the probability that the option will be in or out of the money by expiration. So just to highlight that point, if we went all the way to the top of our screen, Denver, if we go like all the way up to the 300 call,
Yeah.
1 cent.
what's the price of that option right now?
That's
1 penny.
1 penny.
1 penny. So we'll just call that's zero right now, right? There's really no market for that option. And we have to ask ourselves why. Well, if you look at that, right, McDonald's trading at $240 a share.
Yeah.
What's the probability that McDonald's gets to $300 in the next 30 days, roughly? Well, not much. The options are telling us that there's really not a big chance that that's gonna happen. Obviously, that can change. If McDonald's spikes up in the next few days, eventually you start seeing those higher strike options start gaining value.
That's so cool. It's like you can learn from the options chains themselves.
Yeah, so much crucial information on here, and you really can learn and gather all of this information just by viewing the chain. Still scratching the surface here, but just so much great information.
Yeah, and I see why it's so important to understand the options chain.
Definitely.
On the next Options Trading Essentials, let's take a look at a put option example.
Buyers of put options are typically bearish. They want the underlying stock to go down. Sellers of put options are typically bullish. They're hoping the price of the underlying stock goes up.
Kind of similar to calls, but the opposite end of the spectrum.
You're blowing my mind.
Thanks for watching the video. If you enjoyed this episode, smash that like button, leave a comment, and don't forget to subscribe to the channel to get alerted when new episodes become available. Remember, options involve risks and are not suitable for all investors. Before trading, check out the link below in the description.